How do we define non-current liabilities? And answer of course is very simple. A liability which is not a current liability is a non-current liability. It is as simple as that. Now what does it mean? It simply means current liabilities are the liabilities of a business that need to be discharged within 12 months from the date of the balance sheet. Non-current liabilities are those liabilities of a business which are to be discharged beyond a period of 12 months from the date of the balance sheet. And that is the difference between the current liabilities and the non-current liabilities. So let us take an example of non-current liabilities, long-term borrowing. So you have taken a loan from a bank for a project which you are going to pay over next 5-10 years. It is your long-term borrowing. So it is your non-current liability. Deferred tax liabilities. So deferred tax liabilities, in the accounting and in the income tax, the rates of depreciation are different. Under the Companies Act, the rate of depreciation is lower, and under the income tax, the rate of depreciation is higher. That means what? That means uh, under the Companies Act, you charge lower amount of depreciation in the initial years, and lower amount of depreciation in the earlier years, and that generally would remain consistent because you will use straight line method of depreciation. Even if you are using written down value method of depreciation, your depreciation that you will charge under the Companies Act is going to be lower than the depreciation that you will charge under the Income Tax Act during the initial period. That means what? That means because of this difference, you will be getting tax benefit in the initial years, which will get offset in the subsequent years. So this benefit that you get in the initial years because of the rate and the method difference under the Companies Act and the Income Tax Act, you end up paying lesser amount of tax and you create more tax liabilities. So that is why this is known as deferred tax liability. Other long-term liabilities would mean what? Let's say, for example, you have a supplier in Germany, and the supplier in you have purchased a plant and equipment from that supplier in Germany, and you are going to pay to him after 2-3 years. So this is not a loan that you have taken. It's not a borrowing, but this is a liability. It is a long-term liability that you will pay to the German supplier after 2-3 years, and that is known as your other long-term liabilities. And then you have a long-term provisions. So short-term provisions would mean expenses that you will need to pay within next 12 months. You have to pay those amounts, but you are not sure of the amount, and therefore you make estimates, and based on the estimates you make provision. Long-term provisions are same. Long-term provisions are the expenses that you will need to pay beyond a period of 1 year. Again, you are not sure. So let's say, for example, you have leave encashment. Now leave encashment will happen, as and when the employee would leave. So today you do not know as to when is he going to leave. So what is going to be the amount that you will need to pay to him on account of leave encashment, or superannuation, or provident fund, or gratuity. So you will need to make provision of these amounts in your balance sheet, which will come as an expense from year to year in your P&L also. Uh, these are your long-term provisions because they will be discharged beyond a period of 1 year. So this is how you will understand your non-current liabilities. So if you have any question on this part of the balance sheet, please go ahead, else we will shift to the asset side of the balance sheet.